right. Hi, everyone. Welcome. Welcome to our deep dive into market analysis today. Thank you for joining us as we give folks another minute or two to join. We are going to put one or two simple poll questions up. We'll do a quick tech check. Hopefully clicking buttons and all that will work for you all. Please feel free to let us know your answers to these questions. It helps us get to know you better, what brought you here today, and then we'll get things kicked off and started, but hopefully you can hear okay. Good to see some names.
And just to give you all a kind of, hopefully by now you realize this is the part 2 of our series of our Taylor investment opportunity. The first was the overall presentation of the opportunity. If this is the first webinar you are attending, that is recorded on the homepage of the investment. So this is really a deep dive into the market, the fundamentals, and basically how we analyze deals like this to bring them to our investor community. We've done a couple of these in the past, a lot of good reviews. So this is really an opportunity for us to kind of pull back the curtain on how we do what we do in analyzing deals. We have Brad, our acquisitions analyst. He is on as well, so he's going to be available for some questions, and hopefully he doesn't have any technical challenges. He's traveling, so we did record some pre-recorded words from Brad, so we'll share that. So again, there's a polls on your screen. If you want to take a second, and in a minute or so, we will take a look and we will jump in.
Great. Thanks to those of you responding. Really appreciate it.
Yeah, we've got a few. We'll wait till the whole popcorn effect of when things stop popping, then we'll close the poll and keep going. So I still see a bunch of you jumping in. So again, thank you.
And today we do have slides and a few things prepared, but also since this is really meant to be more of a pulling back the curtain, a little bit more informal today. Feel free to pop specific questions into the chat, things that you're most looking to get out of today's time. And if we do everything correctly, we'll have plenty of time at the end for Q&A. Make this much more interactive and informal to make this most effective use of your time. So thanks all for being here with us today.
All right, so we've got 103. We are going to hop right into the program. We're going to start with just sharing a brief overview of the opportunity, and then we will dive in.
Here we go. Click all the right buttons.
Since the launch of our Taylor, Michigan self-storage opportunity, momentum has been building fast. The store is now open and actively leasing, with 27 new rentals secured in just the first few weeks. That early success has drawn even more interest from investors. And today, we're excited to welcome those of you joining us for the very first time.
Are you ready to be part of Detroit and Motor City's comeback story? We're launching a brand new self-storage investment opportunity in Taylor, Michigan. This is a 93,000 square foot, 900 plus unit Class A facility, brand new, opening the doors, fully built and ready for lease up. Just off of I-94 and minutes from the Detroit Metro Airport. This is a very high visibility corridor that sees over 70,000 vehicles per day. For this investment, we're targeting an over 20% IRR across two classes of investment, over 30% AAR, and over 2x equity multiple.
It's Thursday, September 4th at 1 p.m. Eastern, and Hearthfire Holdings welcomes you. Today, we'll dive into the market analysis and demand behind Metro Detroit, and why Taylor is one of the strongest submarkets for Class A self-storage. Whether you're new to this opportunity or continuing the journey with us, you're part of one of the most exciting investment stories in the Midwest. Welcome.
Okay, so as we jump in here, we'll do a quick recap of the investment opportunity. Then we will share a little bit of the market analysis from Brad and what we're going to cover, and then we're going to dive in deep. As a reminder, this is being recorded, so if you have to drop, totally understandable. We will be sharing the recording as soon as we are done here, so look for that. So as a reminder, mentioning what's already been shared, this is a brand new investment in a Class A self-storage property that was newly constructed, that is open for business, actively leasing up. For the Class A investment shares that are being available for reservation are between now and September 15th. Over 50% of the shares have been allocated. We're targeting a 10% preferred return, 21 to 23% internal rate of return, 2.5 to 2.7x equity multiple, and a 32 to 35% AAR. Disclaimer, this is an informational purposes only presentation. Please keep this confidential. If you would like to share the recording, do so only to qualified individuals. This is a 506C investment opportunity only available to accredited investors. The market information is obtained by third parties, and we do not independently confirm these reports. Projections are hypothetical based on estimations and assumptions and not guaranteed of future returns or events, and actual returns may vary, and there is risk with such an investment. This is the agenda that we're going to cover. We're going to talk about the investment summary, market analysis, and then there's some additional resources after. Again, this is a subsequent webinar to our initial launch, which is readily available on our website. So before we jump in, just to reiterate, the location is Midwest. We are capitalizing on a strong corridor, a strong market for a lot of logistics. This is why we are targeting this particular asset. It's a very dramatically undersupplied market, which we will touch on, and it is going to be managed by Extra Space REIT, and it's got built-in momentum with our acquisition and opening of our recently completed construction in adjacent Romulus. So we'll jump in, and we're just going to share a quick video that Brad helped put together on what we're going to be covering.
Hi, my name is Bradley Rayfuse. I'm a senior analyst on the acquisitions team here at Hearthfire Holdings. Today, I want to show you why we're so excited about our brand new offering in the booming Detroit Metro. This facility sits at 24101 Ecorse Road, right off the I-94 and minutes from Detroit Metro Airport. This means constant visibility from over 70,000 vehicles per day and direct access to major economic engines like Ford, GM, Amazon, and the Home Depot. In short, this is a high-traffic, high-growth corridor with demand built in. Within just a 3-mile radius, there are nearly 100,000 residents, earning a median household income of about $64,000. This is a dense, stable population base with both households and businesses creating constant demand for storage. Here's where it gets exciting. The Taylor trade area currently has 6.5 square feet of storage per person, but only 3.0 square feet of climate-controlled supply, far below national averages. Even after 2 planned projects are added, the market is still severely undersupplied. That means our facility is stepping into a gap where demand is high and quality supply is limited. Within 1 mile, the only competitors are older U-Haul and Metro facilities. Compared to our brand new Class A construction, these assets can't compete on quality, visibility, or amenities. Most REIT competitors are miles away, leaving us with a clear advantage to capture the nearest, most motivated customers. The best part, the store is now open and actively leasing up. We've eliminated construction risk and we're already capturing customers from day one. With premium rates, strong visibility, and proven demand drivers, this project is positioned to deliver double-digit IRR and 2x plus equity multiple returns that make self-storage one of the strongest asset classes in real estate today.
Okay, so it's worth sharing if you have questions, feel free to put them in the chat. We're going to save the questions for the Q&A after, just so we have some good continuity going through the deck. Okay, so we're going to jump here, and what we are going to do is really talk about how we go about analyzing a market, how deals originate within our company and how they come to fruition. You'll see that there's a lot of work that goes into it, and then we're going to dive into the market starting from the top level and then zooming in directly in our neighboring comps. So first, our acquisition process is ongoing and an active 24/7 operation. Jeff White, our director of acquisitions, leads the effort. He has extensive experience in self-storage, specifically being one of only a small number of acquisitions directors with CubeSmart, where he spent over 10 years acquiring for one of the top REITs in the industry. And then goes down, and we filter through Brad and another analyst that we have, and Ben, that basically sort through over thousands of properties per month to get us to those 1 or 2 deals that we attempt and we pursue pretty heavily. From there, we're analyzing industry data to compare and look for what we call is our buy box, to analyze market demographics and competitor performance. These are industry-specific tools, specifically geared in some cases directly to self-storage with Radius Plus and Tract IQ. Reonomy gives us market demographics. So we have extensive data that we rely on. The key points that we evaluate include population density and trends. We're looking for a minimum of 30,000 people in a 3-mile radius. What was mentioned already is this particular site has over 100,000 residents in that 3-mile, therefore far eclipsing our minimum threshold. We're looking for rate strength and trends. The 10x10 storage unit is the most common storage unit in the industry. So we evaluate, that's a comparing apples to apples when we're looking at facilities that meet our quality and scale that we're looking for our portfolio. It's a minimum of $150 per month for a 10x10 unit. Mind you, that is stabilized. It's going to be a lower rate while we are leasing up in a facility like this. And then we're also looking at the trailing 12 months of the trends of the rates in the market. Post-COVID, there was a boom in self-storage. Demand rates shot up significantly. They've since come down and normalized, but there are markets that have continued to fall in terms of rates. So we're looking for properties that have started to trend back up over the last 12 months. Obviously, our Taylor property here checks off those boxes. From there, we're looking at a median household income of $50,000. That is the balance between affordability and where the demand needs are being met in a given market. Self-storage supply and demand. These are based on national averages. So 8.5 square foot per capita or per person is where the balance of supply and demand are at equilibrium. So we're looking for facilities that are showing less supply and more demand, which obviously our property here checks off those boxes. And then below that, we're also looking at climate controlled supply and demand, which you heard Brad mention as well. From there, our analysis and underwriting is then assessed against our investment strategies for growth and cash flow as it relates to the specific investment opportunity. We add in the financing assumptions and where we can get conservative leverage on a deal. And then finally, we compare our underwriting to third-party assessments. In this case, it is from CubeSmart, Extra Space, and the appraisal that we get from the lender, which, oh, by the way, has come in higher than our acquisition value for Taylor. Once we combine these, and they are independently reviewed, so we do our analysis and then we're getting the pro formas. It's not getting that and then backing into that. So that basically uses the REITs to validate what we are seeing. And in some cases, there is a little bit higher rate and revenue assumptions. In some cases, we adjust. And from there, that's what goes into our pro forma and how we shape our investment opportunities. We'll turn it over to Corinne. She's going to talk about the broader Michigan and Taylor Metro, and then we're going to dive into some specific assets that we are using as our comps.
Yeah, so kind of from a macro Midwest view, we started in our backyard in Pennsylvania back in 2019 with our first self-storage acquisition. And then since have spread out to Indiana, Illinois with acquisitions in 21, 22, 23. We're very excited to add Michigan to that list with a ground up development in Romulus last year. We really like the Detroit Rebirth and turnaround story. We're so excited to see that happening and to join kind of that turnaround story in Detroit and Michigan overall. Ann Arbor especially has incredibly strong real estate growth. And where we are here in Taylor and Romulus is halfway between Detroit and Ann Arbor. So filling in between those two major metros. You can see the stats here on this slide. I won't read them to you, but is it worth reading?
Yeah, it's worth highlighting that what we're talking
Real
about
folks
is number one ranking for automotive investment. If you're following some of the national headlines as it relates to, there's obviously negative connotations and things around tariffs, but where investments are being made, the automotive industry is there. It's growing. A lot of investments are being made. And the Michigan area is number one nationally. It's number one state for fastest foreign direct investment job growth. Very significant. From there, we're talking about number one for energy sector growth. Number three for manufacturing and employment, et cetera, et cetera. So when we're choosing markets to invest in, it's important that we see momentum and investments being made into these markets from national and other sectors that influence our decisions.
There were huge headlines last year when we first entered into Romulus, and those good news have continued into this year. I'll highlight here the Metro 94 Commerce Center, which is a really great project, converting 70 acres into a Class A industrial campus. The Airtropolis and all of the gains in unmanned flight is really incredibly exciting. There's a ton of that going on in Detroit Metro Airport and other regional airports in this area. The FedEx distribution hub is probably the biggest one. It is open as of a few months ago. They have 7 bays there. They are processing 40,000 packages a day. That's a huge, huge story. So really, really strong infrastructure, logistics, and manufacturing going on in this immediate location.
So jumping into the site demographics, again, reiterate, the Taylor property to Taylor Market is part of the downriver community. The connectivity and demographics for self-storage are excellent. It is adjacent to the Detroit Metro Airport. We have strong residential neighborhoods and saturation levels far below the national averages. I will reiterate, we're talking 100,000 population in a 3-mile radius, 27% renter occupancy, 17% share of the 3-mile market with this new facility, and a very strong median household income of $63,000. The big component here is also the saturation level of 6.2, which is below the national average, and that includes the development pipeline as well. We are choosing extra space, and this complements our management of our Romulus property, which is being managed by CubeSmart. The rationale there is really diversity of management. By having 2 of the top REITs, it gives us as operators direct insight, because we open 2 stores at the same time. We can compare, and they're adjacent markets, not quite overlapping markets. So we will have, for our own sake and for our management strategy going forward, an apples to apples comparison of who performs well for new construction. That is the primary rationale for us choosing extra space. We currently leverage both of their management strategies across our portfolio.
So any market that we're diving into, we've touched on a lot of this already, but we are looking at not only the strength of the broader market, but also as we dive in a little bit closer, who are the employers there? Where are they located, along which major corridors, whether it's large roads, interstates, highways. So you can see here some of the major employers in the immediate area and surrounding. Not at all surprising considering what we talked about: GM, Penske, Ford, and Amazon, and so on. Here we are zooming in a little bit more so we can see where this site is located, really right off of a major intersection here, 24 and E-Course Road, with this really fantastic vehicles per day counts here. You can see on the left where our closest comps are, and I think in the next upcoming slides, we'll really dive into these in much detail. But you can see where they are on the map with the red circle around it, and how our location is really optimally positioned along these major road corridors here.
Yeah, and the comps that we are choosing, we always look to compare our aspirational the true comps, right? While there may be other storage operators, we are looking to really be the more sophisticated comps to look at. And here you see the U-Haul, the Public Storage, and Storage Rentals of America are the 3 that we are looking at today. And we're going to dive in real deep on rates and specifically. So first, let's take a look at the U-Haul of Taylor. So here you have a street view. Now, should know that U-Haul is in the business of obviously renting trucks. They have a really strong storage presence nationally. So among the surveyed facilities, this stands out as the strongest comp. What you see here is the market data showing that the first floor climate control units are achieving $209 per month, or $25 per square foot annually. This is according to Radius. We have validated their occupancy levels are at stabilized levels that we want to see. The data validates the submarket's pricing strength. This is just about a mile away and supports the case that our facility, which is going to be that is brand new, far more modern, and Extra Spaces revenue management will achieve or surpass these benchmarks. It is worth noting, as we're looking at these comps, that our underwriting is stabilizing at a $23 per square foot in year 4, which is below the current averages. So it is important to know that when we're looking at this, we are a brand new facility, but we are not underwriting to say that we are going to come in and price higher. And again, we're looking at the rates in year 3 and year 4 and beyond. The next competitor we're going to look at is the Public Storage on Pelham Road. Public benefits from the high visibility and accessible location. It is an older and lower quality, dated finishes and limited amenities. It is worth highlighting that our asset has interior loading and unloading. We'll see some of the highlights and some of the pictures there. So when we talk about modern, that's what we mean. We talk about everything being fresh. We talk about the storage units themselves having the kind of your equivalent of your soft close cabinets in your house, all of the security features, completely indoors, climate controlled, et cetera, et cetera. It's worth noting that this is below the submarket benchmark of the U-Haul. It is a weaker quality, and that's really showcasing that here. Again, our underwriting is more in lines with what we're seeing at the Public Storage than it is using the U-Haul from there. Okay, so next, we're going to look at the Storage Rentals of America, and this is in Romulus. Again, you could look at this facility. You can see that it is dated strictly from the signage. The paving doesn't have the curb appeal that we obviously have. Again, older, lower quality facility in a secondary location. It lacks the Class A build, visibility, and accessibility to Taylor, limiting its long-term competitive strength, despite serving the same submarket. The market data that we are looking at is showing a $228 per month for average unit, with a $27 square foot per month annually for this property. It's above this submarket. It does reflect the localized demand rates rather than asset quality, as the facility does not meet the benchmarks that we have with our facility. Here is a snapshot of the average rates within the 3 and 5 mile and the 10-minute drive. Again, we are targeting the 3 mile climate controlled assets. That is right square in the middle, and you can see the just about $23 a square foot. That includes some other lower quality non-REIT facilities that we evaluate. Okay, going back to our facility. So we sit directly on Telegraph Road, close right off of Interstate 24. The traffic count there, the 70,000, is the highway. We have direct visibility, so they will see our signage right then and there. That isn't it is not to suggest that we're going to capture all of those 70,000 cars, but it gives us the prominent position in the market for when people in and around that area are looking for storage. They're going to see the Extra Space storage. Add in another 10,000 vehicles per day on Ecourse Road, which is directly outside of our facility, and that's where we're driving the drive-up traffic. Even though right now storage does have a great online presence with being able to use your phone, self-storage near me, it still benefits up to 50% of clients find you from the street and just from drive-bys. So from here, the next part of this is that we're going to share another quick poll just to gauge the level of interest. This is also an excellent opportunity, once you complete the poll, to share some questions. I'll open up the mic to Brad. If you want to ask him anything directly, we see some questions into the chat already, so we will jump into those as well, and then we'll keep the conversation going. Hopefully you found this worthwhile so far. Again, it's our attempt to really just showcasing a lot of what goes into how we identify these opportunities, and more importantly, showcasing that it is a very conservative valuation of how we're going to achieve our business plan, which is leasing up and driving rates. We have other aspects of the deck prepared in here as well. If anybody wants to get back to some of the other parts of the presentation from the first go round of the webinar.
It's also worth highlighting. You kind of saw in some of the screenshots some of the other tools that the team uses, whether it's Radius Plus or just the other sources of data. So we have those detailed reports as well, depending on how much into the weeds we want to go with questions. It's also something we can share offline with individuals.
Okay, we're going to jump to another quick poll. And that would be, go ahead. And that's really to gauge your level of interest. This really helps us to understand, how well we are meeting the marks for where investors are interested. It is worth highlighting, if you're not familiar with our hybrid or dual return strategy, please go back and watch the recording from the first. That is comparing this investment opportunity with our private credit income focused investment, very popular. That is really taking advantage of the higher interest rate environment that we are in right now. So we're going to keep this up for another 20 seconds. If you completed the poll, again, an opportunity for you to jump into the chat and ask questions, and then we will wrap this up. So we're hoping to make sure that we are as efficient with the time as possible. And then from there, we're always available if you want to follow up, have a personal, review of the investment. If anything hasn't popped up, didn't get a chance to ask, or if you're watching this recording, an opportunity for you to schedule some time with us. Okay, seeing the popcorn machine slowing down, I'm going to close the poll and let's jump into the chat. Okay. All right. So first question, how was Extra Space chosen versus CubeSmart? Hopefully I covered that. That is a pure diversification of management strategies. It gives us great insight at the right time. Exactly similar type product. Our Romulus storage is got more drive up, so it's not quite exactly the same, but it is a brand new offering, overlapping or adjacent markets that gives us really good insight. Second question, when underwriting this, what criteria is used to assess the local market demands a premium storage solution at higher rates? Hopefully we were able to answer that question with showing basically what is already being achieved in the market, and that's really a supply and demand factor. Again, we are not far from Detroit proper, the city, so that influences. People tend to commute out of the city. It's 20 minutes outside of the city. Next question, is current occupancy of the nearest competitors? So we we secret shop that, so to get an idea of where they are. We can also look at the rate trends, because when you have a really strong rate online, and we can look at their website to see how much they're discounting, are they offering extensive months free, we're able to determine how their pricing aligns to what we are doing. So from that standpoint, these competitors are believed to be stabilized. When we were out there we did drive through and drive around these facilities without asking the manager, how occupied are you? We can use the data points that we have to be able to get a really good feel for it. How is the other Hearthfire investment performing in the market? Excellent. So we opened that store about maybe a week prior.
Romulus opened August 8th.
August 8th.
And we're 1% ahead of schedule on square foot lease up. We're at just shy of 5%, and our projections were 4. So we're moving along at a really nice clip there.
And it's worth highlighting that we are heading into the slower lease up season. So our leasing velocity is really based on taking the leasing that we expect over 12 months and understanding that the seasonality, we're going to have some slower lease up initially and in winter. I truthfully am very optimistic with Taylor because we have the beautiful indoor loading and unloading, which in Detroit really works well. We have some pictures of the facility
Let me go find that.
in here as well. We could jump to the photos of the property.
Bear with me, Willie.
And you'll be able to see that as well. Next question. What is the projected timeline for the full return on investment? We are targeting a 5-year investment, 3 years for occupancy lease up, 4 years for revenue lease up or revenue stabilization, I should say. And then from there, we're looking at a potential recapitalization or full on exit. As a reminder, our investment strategies, they're nuanced, meaning that there are market factors at play. We've got really strong financing on this. We've got up to 8 years of financing available. So we've got really good financing terms, but we evaluate how is the property performance versus our initial underwriting? How is it performing in relation to the overall market? Do we like the momentum? And then there's also ability for us to convert the investment into a new type of investment, which might mean going from growth oriented to cash flow focus.
So you can see in some of the photos here, this bottom right, this is the all interior drive-in loading bay. So you can see massive garage doors. You can get a moving truck fully inside. So if you are having to move in the middle of a snowstorm in Detroit, all you have to do is pull in your moving truck and you're inside and you're able to get in and out. These photos just do a really great job of representing the Class A institutional quality finishes inside the facility.
I'll take the next question. And while I'm doing that, if you want to flip to the return projections on the $100,000 investment, that would be good. Since the market is so undersupplied and HR has a competitive advantage, I believe that means Hearthfire. Why is the hold projected 4 years? So the lease up, the business plan of these assets is we are talking about leasing up 93,000 net rentable or square feet. That's a lot of storage that we are leasing up. So the idea here is we have discounted rates. We drive occupancy to get it from 80s to 90% occupancy, and then we push really hard on rate. That churn or that velocity for revenue increases really starts to happen year 2, year 3 into year 4. By year 4, that's when we start to realize where is our peak revenue that we are targeting to achieve. And then year 5 is really about optimizing and looking for the strongest exit potential.
I think we also have a project timeline here. Yeah, so we can see where we project to be stabilized.
Okay. So did Taylor start with store space management? Why the change to extra space? So the folks at Store Space are part of the joint venture that owns this facility right now. This is who we are buying this from. Question keeps coming up, says, why would they be looking to exit? Well, first of all, and I personally have spoken to principal, and what we understand, again, this is really understanding. Number one is we do expect that from the development of this asset, they are turning a profit upon sale. Whenever you're doing new construction, there are multiple exit points where you can lock in gains. The first is when you get an asset shovel ready. The second, which is the case here, is when construction is complete. The third is sometime during lease up, and then there's also potentially, after lease up. So in this particular case, what we understand is this is a joint venture that has including the developer, including a third-party equity partner, that they're basically having a diverting investment strategies, not particularly with this asset, but just in general, they are locking in some gains. So that is the rationale. With regard to why not stick with store space, we use national REITs for our management. Store space is a phenomenal operator in the industry. They are top 20. Extra Space is number one. So anytime we're looking at who we're going to use number one, for obvious reasons, and CubeSmart for our other assets. Let's see, has the slower lease up factored into the projections? So the actual lease up of this is ahead of projections. If we mean the seasonality, we do have a blended return or a blended leasing strategy that we've incorporated, or lease up strategy that we expect it to slow down over winter months and then pick up and accelerate coming out of spring. So we heavily discount now, get more units occupied, and then we start to get additional momentum coming into the spring.
And Valmik, I pulled this slide up so you can see in year one, we're projecting we get to 30% occupied, and then 60 in year two, and then 90 in year three. And from there, from year three on, is where we're getting to economic stabilization rather than physical.
What you also notice is that typically the way the REITs, they budget for leasing up about 5% per month. So you can extrapolate that 60% a year. Obviously, we are not expecting to lease up 60% of the units in year one. So that is heavily discounted to do 30% per year over the first 3 years, and then we push. Now, obviously, the leasing velocity, we get to control that a little bit in the sense that dynamic pricing is what informs how fast we lease up. So you can keep lowering the price, add more discounts to be able to get more units filled, and then you push rates from there. The question on distribution, if no full exit, yes, we do have cash flow being forecasted, and that was in that one slide, the cash flow slide.
Sure. Okay.
You'll see that this is modeling $100,000 investment, and you can see that the Class A shares. This is showing 11,000. This is a $200,000 investment, so you're looking at a return percentage of about 5 to 6% year three, and then above 7 year four. So that is the cash flow that we are forecasting. In the meantime, we do have, going back to the dual return strategy, if you're interested in higher cash flow, then you want to pair such an investment with our private credit fund, the Hearthfire Income Fund.
Brad, thanks for answering the question about the market supply. I was trying to get to those earlier slides where we speak about that on the square foot per capita. Brent, yes, this is 1031 exchange eligible.
Brent, we have quite a number of folks interested. Obviously, the timing is critical. We are closing on this acquisition on October 15th. So unless you have a property already under contract and you meet our minimum thresholds for a 1031 exchange, reach out and we can discuss that. Then it's really about the timing. Okay, I'm starting to see question. Do we have a link with more information? So we are going to go back to the slide here that you can use. Hopefully I find it properly, to, if you're interested in either scheduling a call or reserving shares. I will promise I will get there. There it is right here. So there is
It's just an email. This H part here, I'm going to send this.
that is the URL to access the page with all of the information. And then the simple answer here is we're looking for an investment commitment, which is a soft commit to get into the Class A shares, which expire September 15th. So if you are interested, place a reservation. We can continue due diligence. We can schedule a call. The funding timeline is sometime in the first week of October. Jig, that is when capital must be in for us to be able to ensure that we are closing timely.
Closing day is
October
October
15th.
15th. Please don't give our transaction coordinator a heart attack. and
Sean,
on the
do you want to
14th.
see the dual return strategy slide again? And here it is. It's also worth mentioning if you have passive income that you're looking to offset, we are passing 100% of the depreciation, including bonus depreciation, which we are doing a cost segregation study. And the preliminary losses are going to show up to 50% paper loss year one. So if you invest $100,000, you're going to get a K1 that shows a loss of $50,000. Obviously, that is not an actual loss, but that helps offset other passive income. We are not tax professionals and must use that disclaimer. But that is something that is very popular due to the bonus, 100% bonus depreciation coming back and everything associated with that. If doing a dual hybrid investment, is it possible to have insight on the credit funds holdings? Happy to share more on that, Boris. Yes, we do have some information related to that. Thank you for all the wonderful questions. This is really fantastic. Hopefully we didn't go too fast, but again, we will be sharing the recording, and we do welcome the opportunity to discuss anything further if you need a little bit more information for due diligence. It's worth, I see a few people typing. You're very welcome, Jake. Thank you so much for being part of not just this webinar, but as an active investor with us with a number of time.
All right. Hopefully everyone appreciated this kind of deep dive behind the scenes, really digging into
One more
markets.
question coming
One
in.
more.
I assume we can invest via liquid funds or SDIRA. Absolutely. This is self-directed IRA eligible. UBIT does apply. That is something that not a lot of other platforms may mention, but we make mention of that. So make sure that you understand the implications of that. But absolutely, this is eligible for self-directed 401ks and solo 401ks as well. Solo 401ks, I believe, are exempt from, well, I don't want to speak out of line.
Let us know if there's any other kinds of deep dive topics that you'd like to see. And we'll incorporate those, whether in this project or in future investment offerings. If there's other topics specific to an investment that you really want us to go deep into, more than happy to do that. As Brad put in the chat, if something pops up to your head later, reach out. We're more than happy to hop on a call and geek out on the details.
One other thing worth mentioning prior to us saying thank you again and goodbye is if you're in the area or want to do due diligence on us as a company, we regularly host in-person get-togethers, right? Office visits are very much a part of what we do here. We typically have one or two prospective and existing investors pop in once or twice a month. Happy to give you a deeper dive, meet the team, really get an inside feel for how we operate here. We want our experience with our investors to be, that is paramount to us. So we are a relationship driven firm. Also to reiterate, up to 30% of our team has actively invested in our deals. So we're alongside with our investors. So we love that as a way for us to make sure that we are fully connected. So thank you so much for your time. Looking forward. And again, if you're interested, there's a form at the top of that link that was shared. You will get the recording as well. Feel free to shoot us an email if you want to place a reservation. We're very thrilled for how well this investment opportunity has been received, and we look forward to continuing to grow together.
Take care, everyone.
Thank you.